Dear students, today we'll solve a problem on final accounts of a sole trader. This is video number 9, problem number 10. I'm Dr. Pandu Ranganayak, Principal at Swiss College, Bengal. Let us go through the problem. Here trial balance is given and some adjustments are also given of Kshitij Raj, Kshitij for the year ending 31st March 2020. With the help of which you have to prepare trading account and profit and loss account and then balance sheet. Now let us first go through the adjustments. So first adjustment is stock in hand on 31st March 2020. And this is a common adjustment. It should be credited to trading account. One treatment, any adjustment should be treated twice. So once it should be credited to trading account. So buy stock, closing stock or stock in hand 7,000. Another treatment is it's an asset will come to the asset side of the balance sheet. The current asset is 7,000 rupees. So these are the two treatments. One is credited to trading account. Another treatment is shown on the asset side of the balance sheet as an asset. Second one, allow interest on capital. Interest on capital is an expense. It is an expense. So it should be debited to profit and loss account. So profit and loss account debtor to interest on capital 2,500. And then in the balance sheet, another treatment, it should be added to capital. So opening balance of capital plus interest on capital. So that should be added. Second part of this adjustment is on drawings, interest on drawings 80 rupees. So interest on drawings, it's an income. Therefore, it should be credited to trading account. So sorry, profit and loss account. So profit and loss account is credited by trading by interest on drawings rupees 80 rupees. Let me repeat. So profit and loss account should be credited with rupees 80 as interest on drawings. And in the balance sheet, interest on drawings should be added to drawings and total drawings should be deducted from capital. Okay, this is about second adjustment. Look at the third point. Stock valued at rupees 3,000 destroyed by fire and the insurance company admitted a claim for rupees 2,000. So here the total loss caused by fire should be credited to trading account. So trading account is credited by goods destroyed by fire 3,000. Then insurance company admitted the claim of rupees 2,000. So 2,000 is due by insurance company. That will come to the asset side of the balance sheet. So the net loss, that is 3,000, the total value of goods destroyed, and the amount admitted by the insurance company 2,000. The difference between the two is nothing but net loss, which is irrecoverable. Therefore, it is debited to profit and loss account. Actually, entry is like this. Goods destroyed by fire account debtor to trading account with 3,000. Then, insurance company account debtor 2,000. Profit and loss account debtor 1,000. To goods destroyed by fire account. Ultimately, net effect is insurance company account debtor 2,000, profit and loss account debtor 1,000, trading account 3,000. So this will be the ultimate effect of those two entries. Treatment is trading account is created by 3,000 with the total goods destroyed, total value of goods destroyed. Net loss to the profit and loss account is 1,000. And 2,000 will come to the asset side of the balance sheet as amount due by insurance company. Look at the third one. An amount of 10,000 included in sales represent goods sent on sale or return basis. It included a profit of 20,000. So sales, 10,000 is included in sales, which is considered to be goods sent on sale or return basis. So that cannot be treated as actual sales, because on any day after the last day of the balance sheet may return the goods, in which case the financial statements show wrong, or rather financial statements will be misrepresenting the financial position of the concern. Therefore, it cannot be treated as actual sales. So what has to be done? So the value of goods treated as sales should be deducted from sales. Okay, here it's not mentioned whether it is the cost or invoice price. Therefore, we can easily assume that that is the invoice price or selling price. So 10,000 should be deducted from sales on the credit side of trading account. Similarly, from the debtors, you have to, yes, actually when you sell the goods, the entry will be debtors account, debtor to sales account. Now the reverse entry, sales account, debtor to debtors account. So on the asset side of the balance sheet, 10,000 should be deducted from sales. Okay, yes. Then another treatment is, it should be taken as stock. In other words, that should be added to closing stock. So while adding to the closing stock, you have to take it at cost price. What is the cost of the goods treated as sent on sale or return basis? So cost means selling price minus profit. Your profit is 20%. If nothing is mentioned, we will assume that it is 20% on selling price only. So 20% of 10,000 is 2,000. So 10,000 minus 2,000 is equal to 8,000. Cost of the goods sent on sale or return basis is 8,000 after excluding profit. That should be added to closing stock. Closing stock appears in two places. One is trading account, another one is an asset on the asset side of the balance sheet. So in both the places, so that 8,000 rupees, 10,000 minus 2,000, 8,000 rupees should be added to closing stock in the trading account as well as in the balance sheet. Write off rupees 500 as bad debts. So you have to find out whether bad debts are there in the trial balance. Okay, if no bad debts are there in the trial balance, okay, it should be treated twice. Therefore, first it should be shown on the asset side of the balance sheet. Sorry, it should be debited to profit and loss account. So two bad debts, 500, it should be taken to the outer column only straight away. Okay, then it should be deducted from debtors on the asset side of the balance sheet. Let me repeat, it should be debited to profit and loss account, and then it should be deducted from sundry debtors on the asset side of the balance sheet. If bad debts are given in the adjustment, that should be treated twice, once in the trading and profit and loss account and again in the balance sheet. In the trading and profit and loss account, it should be debited to profit and loss account, and in the balance sheet it should be deducted from debtors. Then rupees 300 as provision for doubtful debts. So amount is given, you need not calculate. The formula is like this: in profit and loss account, bad debts given in the trial balance, if any, add further bad debts, add new provision for doubtful debts, in our example 300, from the total. Old reserve for or old provision for doubtful debts should be deducted. Here in this problem, old reserve is not there. Therefore, total amount, bad debts as well as provision for doubtful debts, could be shown to the outer column. And in the balance sheet, this new provision for doubtful debts, 300 rupees, should be deducted from sundry debtors. Alright, the next adjustment is the manager is entitled to a commission of 10% net profit before charging commission. Here what you have to do is, you have to total the credit side of the profit and loss account and total of debit side uh, of the profit and loss account before calculating the net profit. So once you get the difference, you have to calculate 10% of that. That is 10% of the profit before charging such commission. So what I am telling is calculate the total of credit side and calculate the total of debit side. Find out the difference. That is the net profit before charging commission. Now you calculate 10% commission on that. So 10% of profit before commission, that is nothing but manager's commission. And if you deduct that commission, then you will get net profit. Now the treatment of manager, once you calculate the manager's commission, it should be debited to profit and loss account. One treatment. Another treatment is on the liability side of the balance sheet, commission due to manager. So this is what you have to do. If it is given after charging such commission, then the procedure is same. The formula is different, that is 10 by 110, because the difference which we call net profit, that includes not only, the difference includes not only net profit but also commission thereon. So there is no other method than calculating using this formula, that is the difference between the profit and loss account into percentage divided by 100 plus percentage. Here in our example 10 by 110. That we have to calculate. But of course here it is given net profit before charging such commission, that is given 10 by 100. If it is after charging such commission, 10 by 110. Okay, I have covered all the adjustments. Now let us look at the items of trial balance and let us see the treatment. Capital and drawings. Here, though it is given capital and drawings, capital is always a credit balance 50,000 and drawings are 3,000. Capital and drawings both will come to the liability side of the balance sheet. Opening balance of capital 50,000. To that you have to add interest on capital. Then net profit, if any, that should also be added. Therefore we have to deduct drawings including interest on drawings. Okay. Stock at the beginning. So trading account opening balance. Purchases and sales. So here purchases are 20,000, sales are 80,000. Purchases will appear on the debit side of the trading account. Sales will appear on the credit side of trading account. Returns. Here remember, there are both debit balance as well as credit balance. Both the balances are there. So which is purchase returns and which is sales return? For your information, purchases is a debit balance. Therefore, purchases returns should be a credit balance. Here in our example, 400. And in our example, sales are 80,000. Therefore, sales returns are debit balance 1,500. So, this is 1,500 is sales return and 400 is purchases return. This you have to remember very well, very clearly. Wages will appear in the trading account, debit side. Advertisement, profit and loss account, debit side. Interest on loan to Smith. So this is relating to this item. Loan to Smith at 10% on 1/4/2019. That means at the beginning of the year. So here the balance sheet is on 31st March 2020. You have to prepare the balance sheet on 31st March 20. Therefore, the loan is advanced at the beginning of the year. On 5,000, at the rate of 10% comes to 500 rupees. So 300 are paid. Interest or loan to Smith already 300 and not paid, received. It's an income because you have advanced the loan, so interest is an income. So 300 is received. So then what is outstanding? Total interest is 500, out of which you have received 300. 300 plus 200, totally 500. Ultimately, interest accrued is 500. Okay, so how it appears? So in the profit and loss account credit side, 300 plus 200 together 500. In the balance sheet, 200 is to be received. Therefore, it's an asset. on the asset side, you will write interest on loan to Smith. Investment, it's an asset. Bills receivable 3,500 it comes on the asset side of the balance sheet, current assets. Bills payable, it is a current liability, will appear on the liability side of the balance sheet. Sundry debtors 20,000 and creditors are 16,000 each. Sundry debtors will come to the asset side, creditors will come to the liability side. Of course, other adjustments are to be made to the account, concerned items. Furniture and fixtures will come to the asset side, fixed asset. Land and buildings, it is an asset, fixed asset. Machinery is also a fixed asset, will come to the asset side. Cash in hand and cash in bank are current assets, will come to the asset side of the balance sheet. So I have covered everything. Let us see the solution. I have already explained everything. This is just a recollection of what you have learned now. See, opening stock 8,000. Purchases less purchases returns. I told you the credit balance should be deducted. So 19,600. Wages, all direct expenses have to be taken here. Only one item is there, wages 6,900. Sales 80,000 less sales returns 1,500. As a result, 78,500 is the balance. Therefore, we have to deduct goods sent on sale or return basis or at selling price. If nothing is mentioned, that is taken as selling price, so 10,000. So what is the remaining value? 68,500. Same value should be taken as an addition to closing stock. Therefore, here see closing stock is 7,000. Add goods sent on sale or return basis at cost price. How you got 8,000? On 10,000, profit is at 20%. That is 1/5 of 10,000 is 2,000. So 2,000 is deducted from selling price. That's why you get 8,000. So 7,000 plus 8,000, 15,000. Then goods destroyed by fire, total value 3,000 is credited. Already I explained this. Now if you balance, total is 86,500 on both the sides. The balancing figure is profit. We call that gross profit, but we write to profit and loss account. This is transferred to profit and loss account. You see here, my trading account 52,000. Look at the profit and loss account. Interest on loan to Smith 300 is already received, but you are entitled to receive 500 because on 5,000 at the rate of 10% that comes to 500. But you have received only 300. Remaining amount is outstanding. So together 500 is the interest amount for the current year. Then interest on drawings, it's an income 80 rupees. It is given, clearly given in the adjustment. Now come to the debit side. Advertisement expenses 5,500. Office expenses 8,050. Net loss on goods destroyed 3,000 is the total value, but 2,000 is admitted by the insurance company. So net loss is 1,000. Interest on capital is given in the problem. Therefore, that is 2,500. Bad debts 500. Provision for doubtful debts, it's also given 300. Here you have to remember, supposing bad debts are given in the trial balance. Then bad debts given in the trial balance, add bad debts given in the adjustment, add new provision for doubtful debts. From the total, you have to deduct old provision for doubtful debts, and the remaining amount should be shown to the outer column. But here, no old provision. Therefore, straight away you can put the value to the outer column. Manager's commission, I told you, you have to find out the difference between the two sides. That is nothing but net profit before charging such commission. On that, you have to calculate 10% commission, and it is calculated like this. The difference into 10 by 100. So you will get 3,473, and if you deduct that, then you will get net profit, which is to be taken to the balance sheet capital account. It should be added to capital account. Manager's commission is shown here once. It's an expense, and again it is not paid, therefore it's a liability. It will come to the liability side of the balance sheet. The net profit is 31,257. Now look at the calculation of manager's commission. Total of debit side of profit and loss account 17,850. Net profit before charging manager's commission 34,730 here. The difference between the two sides. Okay. So total of debit side of profit and loss account before charge. I'm sorry, this is not total of debit side of profit and loss account. It is the total balance of profit and loss account before charging such commission 17,850. Subject to correction here. I have committed a mistake. The difference what you get is 34,730. The total is 52,580 minus 17,850. So you will get 34,730. On that you are calculating 10% commission, that is 3,473. Let me repeat. See, 52,580 is the total, and debit side total is 17,850. As a result, you get a total of, balance of 34,730. On that you are calculating 10% commission. 10 divided by 100. Let me repeat once again. Total of credit side 52,580. Total of debit side before calculating commission is 17,850. The net profit before charging manager's commission is 34,730. On that you have to calculate 10%, that comes to 3,473. That is taken here. And therefore, the balance is 31,257, and that is the net profit after charging such a commission. Come to the balance sheet. Outstanding interest on loan. Already you came to know, out of 500, 300 is received, 200 is outstanding. Cash in hand, cash in the bank, bills receivable, and then amount due by insurance company. So that is the amount admitted by them. Closing stock 7,000. To that you are adding goods sent on sale or return basis at cost price 15,000. Debtors 20,000. Less goods sent on sale or return basis 10,000. Selling price. Bad debts should be deducted, and new provision for bad debts should be deducted. So 9,200 is the difference. Loan to Smith 5,000. Investments 3,000. Furniture and fixtures fixed asset 2,500. Machinery 4,500. Land and buildings 55,000. Come to the liabilities side. Bills payable 2,500. Manager's commission you have calculated there 3,473. Sundry creditors 16,800. No adjustments. Capital 50,000. To that you are adding net profit 31,257. It is here 31,257. It is added. Then interest on capital is also added to that. So total 83,757. From that you have to deduct total drawings. Total drawings as per trial balance plus interest on drawings 80, together 3,080. So 80,677 is the amount of capital after all adjustments. Look at the treatment of goods sent on sale or return basis. Goods sent on sale or return basis, selling price 10,000. Profit included in the above 10,000, that is 1/5, that is 20%. That comes to 2,000. So cost of goods sent on sale or return basis is 8,000. Selling price of rupees 10,000 should be deducted from sales, as it cannot be treated as actual sale on 31st March 2010. The cost price of the goods sent on sale or return basis is 10,000. Sorry, 10,000 minus 2,000, it is 8,000. So it should be deducted from, it should be added to closing stock in trading account as well as in the balance sheet. Okay.